Hello, one and all members of the investment club. All right, so we're here now for the fall semester. It's been great, to be back here, for some time now, a little bit of time, and we're going to pick up basically where we left off. First of all, bit of a market update, just to come back into the picture of like what's been going on, what's happening now, what we can look forward to, and nothing much on a more like macro, like bigger picture has changed. We're still in a market crash for those many reasons, which I went over before and have been going over. This is Steve Miller. This is his video. We're going to watch a little bit of his. He's been in the markets for about half a century, about 40 plus years, 45 years, and really old. And he was on the Chicago Board of Exchange, really well-known institution for, stock exchange. And he's going to show us something that he learned is something of a little lesser known tradition of cycle analysis, when there are rhythms that you can map out in the markets, which is actually very real. Funny enough, candle counting is also real. You wouldn't think so much, right? It's real, it's a thing. Yeah, it's funny like that, you can see it. In any case though, so he's gonna give us something of an update here, and we're just gonna watch what he says here, so let's go for that.
Spaghetti. For those of you that do understand our chart, know this has amazing values of information.
Sorry, hold on a second. See if I can make it louder. There
what
it
I
is.
do on the bottom over here are cycle brackets. This is joint group. What this does is just give us a sense of the energetic movements in the market. That's the money flow. That's really what gives it its energy. And then we add in our momentum indicators and all of the information that comes out of the multiple time frames of cycle analysis to be able.
Really quickly, for context, momentum indicators, because some people might not know, is you can think of it as the velocity of money, like in and out of the market, and how much of it is going in and out at any sort of given time or time frame. Like, here's an hour, the density of money in that sort of sense, and looking at that nature of in and out flow, you can map on whether things are more bearish or bullish. So that's an example of that would be the RSI. It's a really well-known one. The MACD as well. RSI being relative strength index, that sort of thing. They can just show if there's weakness or if there's strength in the market. We'll talk about positive and negative divergences in a short bit. That has to do with momentum indicators. You can see that, and so it'll be more context there. But
to understand the market projections. So what we have right over here, as you can see, is a rising cycle and a declining phase of that cycle. And you can see right here, that was the ideal, and this is how it resolved. So right up on here are the actual cycle lines, and these are the ideal. Same thing right in here that you can see as the bottom right here with both of these energetic cycle, the energetic movement in the cycle was down, and here's where it rallied. It got nowhere. We call this a left-hand translation, and then completed the cycle almost spot on time. You can see that. This cycle right over here, as you can see, these two were negative. This was extremely positive. And we talked about what we call a swamping going on. So let me take a closer look right over here. You can see that this last cycle, this cycle right in here, couldn't even correct. While these things were coming down, these energetic motions, the upward momentum is illustrated here as you look at the slim ribbon, which is our really great momentum indicator, was moving up, and it wouldn't allow this decline. Also, you can see on the bottom, slim ribbon PO. This is green, and that arrow says upward momentum resumption, and you can see it moved up as we expected. It got over the big 50% retracement, and out close to that 61.8%. I'll show you the NASDAQ, which is much weaker. But then after this rally, it came down and tested this low and then voted. That is very negative. Now, if you saw our analysis the last couple of weeks on the intermediate term, we talked about the likelihood of it getting down near 3,900. Well, there's a low at 3,903 on Thursday. So it followed that.
And we'll look at the technical analysis showing trend lines that vet that. Like it was weird. Sometimes what'll happen is you'll draw these patterns and these channels out before they really happen, and then you see it happen. It's like fun. It's real.
Here, these are the minor cycles right here. As you can see, this one right here and this one right here. And here is the low area where we would expect to get that low, minor bounce comes right in here. And then you potentially get up into these sell zones.
Okay, and that's basically all he says. But just to make that more cement, so he has these periods drawn out, and that's you can look at like volume shelf profiles, and it's gonna be a little hard to draw up here. But basically, what it looks like is you can see the amount of shares that were traded, and they help to be able to see in it and have insight into what you could say is horizontal support levels and resistance levels, which is like, so an example, like see the straight line, there is, if you could have volume shelf profile as like a part of this over here, you could see that there would be a period here over here where there's an increased amount of shares that were traded in this area. And as classically as the market works, when those levels get broken and you see like it became red, bearish, that it is going to be all the harder for it to be able to get above that. And again, this is in the macro context that we are in a bear market that is getting out of the largest stock market bubble that's ever existed. So it makes a lot of sense like that. And he's just saying that for cycles coming down over here, and very well probably a resumption for the larger bear market in a more obvious sense, like when you look at it, it's like, yeah, that sort of thing. So there's that. And then I wanted to say really quickly as well that this day right here, this massive like 3.5% drop, that came in the context of the Federal Reserve Chair coming out, Jerome Powell, and coming out saying very hawkish things. And in that context, what hawkish is, the Federal Reserve right now is trying to rein in inflation. To be hawkish versus dovish, being hawkish means to say, we are going to do everything in our power to be able to rein in inflation. That's quantitative tightening instead of easing, which is like what we've been doing with the federal funds rate, with buying the treasury bonds, all these sorts of things. So to put things simply though, what it just means is that instead of being easily able to like lend money to like businesses, that's the federal funds rate. It's the interest rate that's applied to the money that is borrowed by banks, which they then lend out to other people to be able to get like mortgages and business loans, car loans, and everything else. When that is raised, it is then harder to get money. When it is lowered, it's easier to get money. What happened when we saw with the COVID and why we had this like massive bull run is because the federal funds rate, this is part of the picture, they were also buying stuff that has to do with other quantitative easing. They lowered it so much that all of a sudden all this extra cash was then just plunged into the markets, and we had this massive bull run. That's more or less the picture. I mean, I could add some other things there, but that's basically it. So now they're tightening things. It's going to be harder. That was a major punch bowl, if you will, that allowed the market to go on this massive bull run that we saw since the bottom of COVID in March of 2020. Now it's going to be the reverse of that. And then in the context of massive market bubble, which, classically leads to downfalls, so there's that. And then let's see the next part that I want to show y'all. So there's a really cool bit in here, and I think this is going to be the next part that we're going to be talking about. And sorry. Okay, so one thing really quickly, I've been wanting to do this. So for the reason why I do this, a major reason why at least, is not to just help people become more financially literate. I couldn't even say the irony of it all. To become more financially literate, although that is very important to me, is also because I believe in charity a lot. And there's 3 charities that really stood out to me as I did my research on them. That's Charity Water, and Austin Pets Alive, and then World Central Kitchen. Those are really good charities. If you make money from any of this free information I'm giving to you, please do look those up and be willing to give, because I think there was sort of like a line I gave. Hold on a second, because it's a really good line. Obviously not just a line, but as an actual emotional reality that I believe in. The world is better when we care together. On the cards here. In any case, there's that. And also, if any of the information here useful, please feel free to bring along your friends to the meetings. There it is. Okay. Anyways, all right. So there's that. Next bit. Here we go. And okay, okay. So we go over a lot of stuff that's like, here's some needed information in order for you to be financially literate. I mean, just like straightforwardly. And then other things we'll have like life hacks, So one of the, here's an example of one. There are platforms out there, and obviously you'd want to vet, look around a little bit to be able to make sure that they're real and legitimate. Like Webull is. Webull's, FDIC insured, that sort of thing. Anyway, so there's a number of these things which if you put in, you don't even have to keep it there. That's the cool thing. You can put in like a little bit amount of money, $10, or like a penny, literally just any amount of money, set up an account. It'll take maybe like 20, 30 minutes, and you can get approximately, from like Webull at least, like $50, and you can do that through a number of these things. You don't have to keep the money there. You can get these shares, which is what they're doing. They're going to give you shares. You can sell that immediately, cash out, just sort of like a thing like, hey, if you want $200 for like a couple hours work or something like that, there's an easy way to do it. So there's that. And okay, now we're going to start talking about I-bonds. Okay, so these things are cool. So because inflation is so fucking high, the federal government has come out and they have these new Series I bonds, which currently right now, you have to hold it for a year, mind you. Like you can't just like sell it before then. You have to actually like hold it for a year in order to get this benefit, which is 9.62%. That's really good. The stock market on average only returns like 5 to 7. So they're giving out 9.5% here. And the way that it's also compounded will actually lead to like over 10% because it does it like semi-annually, Anyway, so there's this. I'll put in the website in order to like go to this and look at this website in order to actually purchase these things. You can purchase up to $10,000 worth of Series I bonds, by the way, and so that'll be in the description of the video. So that's really cool. And it's secured by the United States government, so you're only going to lose your money if like America like collapses, which probably will not happen because like look at the fucking dollar. Anyway, so for those who know that the dollar's been like rocketing upwards because everyone else is in like a worse situation than we are. Sad but true. Okay, like Metallica. Anyways, okay, so the use of options in this context. So I talked a little bit a while ago about there's some of the videos on the channel talking about options. Do you have any familiarity with the name of options, that term options?
I know options is different than like the normal investing.
Yeah.
And isn't options? I'm pretty sure it's like all in one day or something.
Kind of.
Like it's more short term than long term.
Not quite. Actually, yes. You could, because you could hold shares of the SPY, which is the ETF for the S&P 500, forever. I mean, you could just die and like you still have them. Options contracts will expire. They have an expiration date, but they can go like a few years out. I was just going to say though that so we can talk about like options and how they work. It's a contract to be able to like have the right to buy 100 shares or something. That's a call specifically. Then you have also a put, which is to sell, the right to sell 100 shares of something, and it's a little more that's pretty rough take of it, but that's basically what it is. By the expiration, there's the expiration date comes out in a few months or something like that, right? A few months passes, you're there at the expiration date, you no longer have that right. The contract has expired, you can't buy or sell anything anymore. So that's what that is. In this context, so I wanted to say this, in this context, there's a couple reasons why, there's mainly one reason why you would ever bother with options, and I actually have options on. I said before, don't do it, because what we were talking about at that time with the inverse leverage ETF specifically was to be able to pass it on to someone else. However, there's such little volume of them trading around that would make it like impossible. What would happen is that you would get early assignment and then you'd probably like lose money on them. It has to do with options. I can explain it later. In this case, however, there is still a viable plan, and it's something that I've actually made money from. If you're expecting money coming to you later on, what you can do right now is you can buy one of these options, and like, so for example, here's an example. HIBS, HIBS, one of the ones that I bought into, inverse leverage ETFs. At about, I think it was like $11.50, $12, I had bought an option that would have placed it as though I had bought at 13. And all of a sudden it's like, oh, wait, hold on a second, you just lost $1. No. Because the amount of money that I would need to exercise to actualize that option, right, the 100 shares, right, that money was coming to me later. By the time I got that money, however, what had happened was that the option contract was to be able to buy at $5, and so that means $500, every contract is 100 shares. And it's at $8 right now, right? So you can see the difference there, even though there was like, it's not an immediate loss, it's just that you had bought it early at like a price tag in order to, which is called the premium, at a price tag in order to later benefit from it because you had money coming to you later. Anyways, so just want to say that, that's kind of the main bit there, so, yeah.
Can you say that one more time, just that last bit?
So the reason why it was advantageous for me to be able to refer to options is because I was getting money to me later that I couldn't use now to invest. I could have bought HIBs at $12, right? Except I didn't have the money because the money was coming to me later. So what I did instead was I purchased a options contract. I sold some shares in order to purchase the options contract. Sold at 12, bought at 13 effectively because that's the premium, and the premium is involved there. And what that allowed me to do was wait until I get my money, which I have now, and the strike price, which is like, so I'm able to buy it at $5, 100 shares. That's part of the contract. $5 is the strike price. It's, it's just terminology. It's now currently priced at $8. There's a $3 difference. I bought $3 cheaper than the current price. I got a benefit, a sort of on sale sort of thing, even though I paid the premium of $1, right? $2 is the difference, plus 2, profit. That's how that works. So there's that. Okay, yeah, okay. So a while ago we were talking about like the idea of putting cameras into your rental properties in order to like secure against like vandalism if one of your tenants was like, I'm gonna write it on the wall today because no one's watching. You don't actually like, because that can get a little expensive to have like constant cameras in your house. What you can do instead, and you're gonna be wanting to do this anyways because like you're gonna have one in the bathroom. No. What you can do instead is have rental insurance. And so there's 3 different kinds. I think we went over this. There's rental, there's renters, and then there's rent insurance. Rent insurance, I'll do this backwards because why not? There's rent insurance, which is the insurance to be able to say that like, okay, so one of your tenants doesn't pay, you got rent insurance. You getting that rent money, don't you worry, baby. And then there's renter's insurance. Let's say someone breaks into the home and steals the possessions of the renter, right? The tenant. Now you have renter's insurance or tenant insurance, same thing. You will not be held liable for their missing or damaged property, right? And then finally, rental insurance. Something happens to the home, right? It's like home insurance, fire burns your house down, except it's in the context of being a rental property. That's what you'd use. So don't bother so much with the cameras. Just simply get rental insurance. And you can look into insurance plans that cover more holistic damages, smaller damages, that sort of thing. Just keep an eye out for that to be able to make sure that like if your wall gets a hole in it, that you can actually be covered for that. It's like, hey, it's going to cost me a couple $100 to be able to fix that. You have insurance. Like, don't worry, they actually cover that sort of thing. Okay, all right, technical analysis time. Here we go. So, the spy here. So there's a bit to technical analysis, and the reason why I think this is important to go over is because if you're going to be investing in stocks, and for the longer term, the longer outlook here, which is holding like mining bubbles and significantly bad news like COVID and shit, holding long-term leveraged ETFs, and I went over a video previously, and what I looked at was a mathematical calculation of a leveraged ETFs, which isn't even one of the better ones, but it was one of them versus just like the SPY itself, and it dwarfed it horribly. Like if for like the last 100 years, if you put in like some paltry amount, some small amount of money, the S&P 500 would have allowed that to grow to 500,000, and then the leveraged ETFs did 13 million. That's holding through every single crash that's ever happened. And there's been a lot of crashes. So if you're mindful about this sort of stuff, you can look at value. We have the fucking internet. You can look at valuations. You're looking at the news every once in a while, something like that. Keep an eye out for that sort of thing. You can avoid getting trapped into like a bad period, that sort of thing. But point is long term, you can really, really dwarf just investing in the S&P 500, and we can talk about that more later. Okay, so yeah, so the reason why this is important to go over is at least, in the very least, to have some recognition when someone brings up this term that you know something. It's launched there in the back of your mind, in the subconscious. It's launched there somewhere. Got something of familiarity, so you're not completely lost in the dust, and the conversation just gets fucked for you, sort of thing. All right. So in a general sense, and this is a bit of a unique sort of perspective and argument. You might not hear this a lot, but it's true. The more connections uninterrupted for a line of support or resistance. So maybe I should start there, but let me just say this. The more lines of connection, the more points of connection, I should say, that are uninterrupted in a line here that you can draw a channel, drawing out a channel, the better the argument. There's nuances there, and we'll get into that in a second. But first of all, let me just say, let's go back to a better example here. Actually, this is the perfect example. Okay, so I know it looks messy right now, and that's because you're drawing sort of like, because what I was doing here, I can get rid of this one. Let me just clean this up a little bit right now. This is the general sort of outline here. Okay. All right, there it is. Okay. So keep in mind that when you draw this is a horizontal line of resistance. When you do these, and you can see like little variances like that, see how there's like a gap there, right? You can see variances like that, and that becomes a zone. It doesn't have to be perfect all the time, right? And that's sort of the idea about but wait a second, you were just talking about if there's contradictions or things that violate your line, then it means it has less than an argument. It's not exactly so. This has to get into the nuance of it all. You can still find these areas of resistance where it happens over and over and over and over and over and over again, right? And there can be slight variation between that. More so for the horizontal, and that's because horizontal lines usually have better arguments because volume of shelf profile is a thing than the slanted lines, right? Vertical lines, I mean, you can draw that out, but that's more specifically for looking at timelines. A vertical line or almost a vertical line won't really make a lot of sense in much of any context other than drawing out time periods. And that's still a part of technical analysis, but beside that though. So you still have these areas of resistance, right? And then below, see here, a little bit over here again. The range maybe varies a little bit. Here, again, here, right? It comes down, right? This is an area of support. If you could see it on a volume shelf profile, it would look like these big mountains coming out, right? These big mountains coming out. So because there's in particular a sort of, I mean, it's a little weird to look at it like this, but it has to do with okay. So look at any sort of random candle, right? You look at this one, this just little red one right here, right? This candle, if you look at a volume shelf profile, what it will tell you is, in a general sort of sense, not this one particularly doesn't work like that, but let's just use it as an example for the sake of communication. This one will have a larger amount, even though it doesn't look like it moved a lot, this one will have a larger amount of shares that were traded in that day than say a candle here in the middle, like that one. You know what I mean? You'll see that as it pans out sort of thing. So you'll be able to see that as it came here to the bottom, there was a fight that happened between the bulls and the bears, and you can see what happened time and time again in general. Speaking here as a range again, right? Is the bulls won down here and the bears won up here, right? That's what happened in that fight, So it comes out more clearly like that. You'd have to see it for yourself, but for the sake of right now. And of course, you find some breakouts, right? This is called a false breakout. The reason why is because even though we could see this range here, right, of resistance, it broke out, right? It came back through and did not break out again. It came back through. This is arguably a retest, this period right here, right? There's some variance here, right? In this sort of area. It retested and then continued to plunge further. So those are what horizontal resistance and support lines look like. Let's look at an example of a slanted line, okay? This one, slanted, again. These are arguably in a sense weaker in terms of their validity than the horizontal. Horizontal usually particularly when it's really clear, usually are like the best arguments, you know. But slanted lines can still work very well in terms of finding a channel. And the best idea is, particularly with these ones, is that it is not going to be so much of a range, and you're going to see very little contradiction. You can see the occasional contradiction where it's like, I don't know, if someone were to draw a line from like, you know, it's sort of out of my ass, but someone, you know, draw a line from here to here, you might see something of a contradiction here, but you might also see something of a validation, you know, small eyes, you know, that sort of thing. But generally speaking though, look through those ones that have the least amount of contradiction to them. And that's not to say that you can't have like a time where it was like invalidated, you know, so for example, here, if this goes and crashes below it, you know, that doesn't mean that this line doesn't mean anything anymore, right? It could still mean something, particularly if it does a retest and then comes back down, that sort of thing. As far as Steve Miller is concerned, we're unlikely to see that, rather a small rebound and then a resumption of the bear market. So yeah, and I was just saying this before, drawing this, I didn't think too much about it at the time. It's like exact, but I definitely wasn't expecting that second day. It came exactly to it. And it's kind of funny to see that sometimes. You can see it happen in real time. It's like, that's cool. You know what I mean? Sort of like almost something of a loose prediction on the future. So again, line of support here. And so that's, you know, roughly the idea with, you know, using these lines, right? You can draw up here, right? On this platform anyways, you know, there's a trend line here. You make a horizontal, vertical line. Trend line will let you, right, draw it however you like, you know, that sort of thing. And it can help with getting a good idea on, you know, is this a good time to be starting to buy or starting to sell, you know? For example, like you can look at the general sort of idea here. You can see this area down here below as it was playing out here, right? This would be a good idea to buy. I mean, not in this context, but just beside that point is bear market, right? But this would be a better idea to buy than to sell. And up here, right, the other way around, right? It becomes up here in this sort of range loosely. There's better examples, but you get the idea, right? There. Okay, gap fills. Yeah, gap fills do happen. Trying to think of where I could find an example here. So I can just tell you. I could just tell you, and that should be fine here. So you see how there's like this gap here? There's none there. It's just a blank space, right? What that is the movement between the after hours trading and pre-market hours, right? These candles mark the regular trading hours, which is, I'm trying to think about this. It's been a while. It's from 9:30 to 4 p.m. Yeah, that sounds right. 9:30 to 4 p.m. Eastern Standard Time. For us, it's 6:30 to 1. That is true. Yes, 6:30 to 1 because time zones. That's what the candles are. The blank spaces you see between the candle and the next candle are the after hours pre-markets. As a sort of classic thing you can see happen over and over again, and there might be something here. Yep, it does. Wow, that's actually really exact. All right, here. This is a good example. Found one, nice. Okay. So you see the actual literal tippy goddamn top of that thing? We've talked about candles and what they look like. So these lines, these really thin lines, are called wicks. It's where it went during the day. For green candles, you see the bottom of the body, like this thicker part, as where it started. It's a green candle, it went up. The end of that body is where it stopped. Right, the wicks are just where it went. So it, came up and went back down. Oh, look, it stopped. Cool. All right, where did it stop? Well, it stopped right there. All right, but it went up there. Anyways, See right here though, the very top of this day exactly filled this blank space, more or less exactly. Seeing this one time, maybe it's not the most convincing thing, but seeing it time and time and time and time and time and time and time, it's a pattern. It happens over and over again. It's just sort of one of those little quirks about the market, right? It's just one of those things. So just be aware of a gap fill. And then there's other things too I could get into, but not really necessary. A gap and run, that sort of thing. It's one of those sort of phrases. Okay, Dow theory. All right. So this one's going to be more of a general thing. It's going to be very easy to understand, and it should be pretty. Yeah. So this is a good one. All right. So I'll go back to days. All right. So there's something called Dow theory, and it makes sort of a reference to the Dow itself, which the Dow Industrials, one of the indices for the market. And what it is first of all, it's I think I had the word bifurcated. God, my friend called me earlier a dictionary. She wasn't lying. So it's bifurcated, which just means it's divided into two. There's positive Dow theory and there's negative Dow theory. What we're seeing right now is negative Dow theory. What this means is very straightforward. It's very simple. Is you see these lower lows consistently over and over again for like a drawn out period of time. If you think about day trading, don't bother. Just don't. It's not worth it. Seriously, don't. Yeah. So these lower lows and lower highs, right? And it's not the most perfect of things. For example, this high is technically higher than this one. This high is technically higher than that one. This is why it's more of a drawn out, longer term scope, right? Over the period of months and over the period of even years, right? Classically, bull markets, that sort of thing. The bull market that happened before COVID really happened was one of the longest ones in history, and it was one of the stronger ones in history too, which is why we got into such a bubble. Lasted for 10 years. Usually a bull market will only last for 6 years until it's interrupted by a bear market. A technical bear market is when the market plunges down by more than 20% or more. That's a technical bear market. So this is negative Dow theory as exemplified recently. And then we can look for positive Dow theory, right? Guess what? Higher lows, higher highs. Same thing, right? It's just this general trend of what the market's doing. See a contradiction here? You can see it. I know it's messy here, but you can see what happens. There's these pointed highs, right? Like this one, right? Where all of a sudden it contradicts the general sentiment. You see these lows. You can see this sort of general broad trend upwards where there's something of a support area, right? It's contradicted by this. It starts changing, yada yada. Anyways, we're in a bear market. Okay, so now we're gonna get into momentum indicators and negative positive divergences. This also has to do with a little bit of Dow theory, but it's let's see here. Okay, so let's trade. There it is. Okay, so let's go with the SPY. All right. So below are two. I'll change this to how do you? Okay. It's been a while since I've changed this. Hold on a second here. No. All right. Well, that's okay. We'll just use the RSI. Oh wait. Is that the MACD? Can you see this? Oh my God. Is there a visible part to it? No. Huh. Oh wait, oh no, I can see it though, it's just down there. All right, there. There it is. Yeah, those are the three I use. Okay. Okay, so like I said before, the MACD, RSI, these are really popular momentum indicators. It just looks at the velocity of money in and out of the markets. You don't have to know too much about these things, but there's a couple things that are important about them. First of all, it acts, as you can see here, particularly with, wow, that looks bright. Is that visible? At all? Hold on a second. I don't know if you guys can see that. At least the MACD though, so there's something there. Oh God, yeah, you guys can't see it. Oh gosh, okay. That's okay. We'll just look at the MACD then. All right. I did not see that. So funny. It looks nothing like that on the screen. Okay. So we'll just look at the MACD here, and you can see with the MACD, right? It's more clear. I don't know why it's so bright, but it's more clear with the RSI. But you can still kind of see the same thing with the MACD. there is nuances between these ones. For the example, the MACD here, you can see a negative crossover. There's this right here. When the blue line is below the yellow line, this is bullish. When it crosses over, it becomes bearish, that sort of thing. You don't have to look into that like too deeply, but it's just something to understand. And then the RSI is going to be better for this one, but that's okay. So negative and positive divergences, okay? So two different things. So hypothetically, because I so much to point it out here, it's gonna be a little difficult, but let's just say that we're looking at the market, right? And it's bearish right now, right? You see there's this high, right, that's higher than this one,